Hello, everybody. Thank you for joining us. This is Nick Curtin from Foord Asset Management, Head of Business Development and Investor Relations. I've got on the line with me Ishreth Hassen, one of the multiple councillor portfolio managers in Foord's Singapore office, a portfolio manager on the Foord Global Equity Fund. We thought it's worth spending a bit of time on the fund, how it's positioned, how it's done. It's had a very, very strong 2020 in terms of returns. Gross about 10% ahead of its MSCI All Country World Index benchmark, which is a fantastic run rate in this market. And yeah, Ishreth's been at Foord for 6 going on 7 years, so he knows where all the skeletons are buried, so to speak, and a very, very experienced global equity analyst and portfolio manager. Ishreth, welcome. Maybe just to kick things off, we can go back to the end of 2019, beginning of 2020. Feels like a very long time ago where we could do outrageous things like go to restaurants or visit the beach or travel abroad. Feels like a long time ago. Maybe just give us a sense of how we saw the world back then, sort of the big macro picture and where we saw markets and how we were positioned.
Well, at the end of 2019, markets were actually quite expensive. They had just reached new all-time highs after posting the best annual return of the decade. That said, even against that backdrop, there were many stocks we really liked and in which we had deep conviction in. So we had built quite a concentrated portfolio at the time. Now, when COVID really started to spread globally, we understood at a relatively early stage that it would have a pretty big impact on the world around us. Now, nobody could fathom the extent of the impact and how it would eventually snowball, but Singapore was one of the first countries hit by COVID, so we had somewhat of a better idea than most. And this was really before markets began to tumble in sort of February, March timeframe as well. But then when we looked at our portfolio, what was apparent was that the businesses we owned should fare reasonably well regardless of the environment. Such were their fundamentals. So we didn't really change much on the portfolio construction side, other than adding some portfolio hedges that allowed us to stay nearly fully invested through all this.
Thanks, Ed. You made the point about some high conviction ideas. I mean, maybe just take a step back. It's always useful to revisit investment philosophy and in the ultimate scheme of things, what it is we're actually trying to achieve. Maybe give us a sense of what the sort of characteristics are that the team looks for in an ideal investment.
Well, ultimately, what we try to do as a team is to identify businesses that are priced significantly less than what they're worth, especially over the long term. We do this by gaining deep clarity around the future earnings of these businesses, which we then compare against what is priced in by the market. We also look at the quality of the businesses as measured by the returns they're able to generate, not just today, but in the years to come. And last but certainly not least, we look for great leadership teams who can deliver and exceed on these returns and earnings.
Thanks, Ishreth. And maybe sort of aligned to the previous comment is give us a sense of what drove the performance through 2020, and I guess that's partly to do with what we did own and partly to do with what we didn't own. I know a lot of the cynics out there say that alpha of sort of 8, 9, 10% is only possible if you were overweight. The large US tech space. That certainly hasn't been the case in the Foord fund over the last year. Maybe give us a sense of what has worked, and as importantly, how long those ideas have been in the fund for, because clearly they weren't things that we did in January last year. A lot of the ideas were planted some years ago.
I think that's exactly right. I mean, in terms of the context, it's worth considering what actually didn't drive performance for us. In the index, as you mentioned, IT was the best performing sector of the year, which was up almost 60% in 2020. But if you look at our top 5 performance contributors, they were JD.com, Freeport McMoran, IPG Photonics, BioLife Solutions, and Tencent, none of which were from the IT sector. Still, all of them outperformed IT as well as all other sectors, and for very idiosyncratic reasons. And that goes back to what I was saying before, on earnings. If our analysis of earnings is right, and that gap between price and value is large enough, it gives you a substantial margin of safety on the risk of losing money on any one stock, at least over the time frames that we consider. And if you own a group or a whole portfolio of such businesses, they really should be an effective hedge against any market environment. And 2020 was no different, Performance was driven by very stock-specific factors that spanned multiple sectors and markets.
Thanks, Ishreth. Maybe just turning to the team, you've been there 6-7 years. Give us a sense of how the team dynamic works. Any changes in terms of responsibilities and function? Who the portfolio managers, the other portfolio managers are on the fund?
Yep. I guess so. So we have Brian Arces, myself, and Dave Foord, who were the managers previously, and then we just had our colleague JC Zhui, who was also appointed as a PM in our multi-councillor framework. JC is a Singaporean and has been instrumental in covering consumer, IT, and communication services sectors for us over the past few years, and should be a great new addition to the PM team. And in terms of the overall team, I would say not much has really changed. We have at least 2 people covering each sector. We rotate through sectors over the years, and the PMs are also analysts, so are very close to the numbers.
That sounds good. Steady as she goes. It's the Foord way, and it's very pleasing to hear. Maybe just as a last comment, give us a sort of forward-looking view in terms of the risks out there. You made the point about markets being expensive, a year ago. We're in this conundrum where equities look expensive, but arguably less expensive than some other asset classes. So we're in a bit of a strange new world. Maybe give us a sense of the risks out there and how we are navigating those in the fund.
Well, that's a bit of a difficult question to answer, given that I guess risk means different things to different people. To us, risk is the risk of losing money over the long term, which in our minds means the risk of being wrong on our analysis of earnings. So, I mean, how we mitigate this risk is by really concentrating our focus on getting earnings right above all else, and constructing our portfolios based on our conviction in earnings.
Ishreth, as always, thanks very much for the time. It's been interesting, and very pleasing to see such a good run rate on the Foord Global Equity Fund. To the end of December last year, it's now top quartile over 3, 4, and 5 years, and top decile over 1 and 2 years, and that's in its Morningstar category. There's 1,600 competing funds in there, so that really is no mean feat. And please, long may it last. Keep hitting those boundaries. Good luck, and thanks for the time.
Thank you, Nick.